So the next speaker is NIels Johannesen, and his presentation has the title "The End of Bank Secrecy," with a question mark, of course. And he will give an evaluation of the G20 tax haven crackdown. He is now an assistant professor at the University of Copenhagen. He researches topics related to offshore tax evasion and avoidance. And he has previously gained hands-on experience with corporate tax planning as a consultant at one of the firms, one of the four, I don't know which, and with practical policy issues as a head of a section at Danish Ministry of Finance. Please, Mr. Johannesen.
Yeah, so this is a paper, or this is yes, this presentation is based on a paper on offshore tax evasion by households. So let me just first make a few general remarks about what do we know and what don't we know about offshore tax evasion by households. So first of all, like, how much money is involved here? So how much money do households have in havens? So obviously this is not something you can look up in a book or official statistics, especially because of this lack of transparency in havens. Nevertheless, there are a few like pretty good ways to get at at the number, and reassuring that these ways like get at more or less the same number. So it seems to be like a pretty reliable estimate that households own around like $6,000 billion in households, which corresponds to around 8% of all like household financial wealth. So secondly, so how much of this wealth is then associated with tax evasion? Well, that's actually a harder question to get by. So I guess that most of us, based on case stories and anecdotal evidence, will say that probably a lot of this offshore wealth escapes taxation, but basically like very little like real knowledge exists on compliance. So people, it's not illegal to have a Jersey account or a Cayman account. So as long as I remember to self-report, of course, my capital income, we know very little about that. But what we can say is that much of this wealth could be untaxed. So the bottom line here is that there is like a very significant fraction of total household wealth which is parked in tax havens, and so it's not surprising that this policy agenda has become very important in the last decade. So how do we bring this capital income earned out there back into taxation in the home countries? So this agenda has been addressed or approached in different ways by different countries. So in this paper, we look at a particular policy initiative that we call the G20 tax haven crackdown. So the key tool here in this policy initiative is information exchange treaties. So these are treaties that two countries conclude with each other. And then so under these treaties, they can then ask each other for information about their residents. So the OECD has pushed tax havens for a long time to conclude these treaties, actually since 1998. But in the first many years, nothing really happened. So the major tax havens like Switzerland, Singapore, and others flatly refuse like this very principle of transparency of information exchange. And many other tax havens actually kind of agreed to the principle, but in practice they didn't really sign any treaties. So for the first many years, no treaties were actually signed. Then suddenly in April 2009, something happens, like a real game changer. So there's a G20 summit. This is around like just after the financial crisis. There are huge deficits in almost all OECD countries. People are really tired of banks. They are tired of rich people not paying taxes. And so there's this political, you could say, agenda comes up again, and now something happens. So the G20 asks the OECD to draw up a list of non-compliant havens. They say that a compliant haven is a haven that has signed 12 of these information exchange treaties. The G20 countries now threaten these havens. So they say if havens do not comply with this 12 treaty threshold, then they will they will make economic sanctions against them. And in a matter of weeks, actually all havens in the world have so accepted this principle, endorsed this principle of transparency, and agreed to sign these at least 12 treaties, and actually also start signing treaties. So just to illustrate how big a game changer this meeting was, I've listed here. So this is the number for each year since 2004. This lists the number of treaties, information exchange treaties, signed by tax havens. So you can see that there are just very little treaty signing activity in the first years, and then suddenly in 2009 there's a huge spike. Havens actually start signing treaties. So the million-dollar question is, of course, this: does it work? And this is actually kind of a controversial question. So the OECD are pretty happy with their own work. So they solemnly declare that now the bank secrecy, the era of bank secrecy, is over. But this is contested by NGOs and many tax experts. There's a nice piece by Nick Jackson and John Christensen called they call this the whitewashing of tax havens. Actually, they say treaties are crap. They don't work. And actually, we are worse off than before, because now we put in place a system whereby tax havens can just sign 12 treaties, and then they are whitewashed, and they are kind of respectable financial centers, which they are not, they claim. So first, so what would be the reasons why this doesn't work? So what are the limitations of this G20 approach? First of all, I mean, and perhaps most worrisome, some people claim that there's something wrong with the very information exchange standard here. So these treaties are based on the standard of information exchange on request. So it means that if, for example, Norway signs a treaty with Switzerland, then Norwegian tax authorities can go to Switzerland and say, we would like information about these specific taxpayers. They can't just ask about all information about Norwegian taxpayers, but it has to be specific taxpayers. And also they have to back up this request by some information that supports that there is kind of a reasonable suspicion. So tax authorities need to know something to get information, right? And this something is really hard to come by. So these information exchange clauses are just not used very frequently. So we know, for example, that the US, with its wide treaty network, only a few hundred times a year actually ask for information under these treaties. So it seems that, I mean, just objectively, so there is a very small risk of getting caught if you under these treaties. Another important limitation is that treaty networks are imperfect. I mean, so no country in the world has treaties with all other countries in the world. So even if a country signs treaties with 20 tax havens, there'll still be 30 left where you can move your money if you want to avoid kind of falling under these treaties. Secondly, thirdly, this 12 treaty threshold. So there have been many treaties between havens. Liechtenstein and Andorra have a treaty, for example. I don't think it has any economic meaning at all. There are treaties between havens and microstates. So Greenland has a number of treaties with havens, although there are only 50,000 people living on Greenland. So some people see this as just the attempt of havens to kind of get to this 12 treaty threshold without giving really any real concessions. Also, there are some concerns about the actual implementation. So do tax havens actually do what they're supposed to do under the treaties? There's some information from the French Ministry of Finance saying that, I mean, many havens just see it as their job just to confirm information that they already have, not to provide new information. So that's another concern you might have. But then again, I mean, so those people who are in favor of this would say maybe this doesn't involve a huge risk of tax evaders of getting caught, but actually, I mean, maybe just a small risk is enough. I mean, if you are a millionaire and you can save taxes in something that is risk-free, you might go ahead and do it. But if there's just a small risk that you go to prison for tax evasion, then maybe you won't do it. So maybe it works, although this risk of detection is very small. But the point is here that we don't know anything about this. So there's no fact-based knowledge about how the economic effects are of these treaties. So the OECD has a huge review process. They have hordes of lawyers looking through these treaties and see if they are well drafted, see if the legislation of havens are well drafted. But if there is kind of fundamental flaws in the treaties themselves, in the very standard of information exchange, then it doesn't matter. I mean, then it's not good enough if the treaties are well drafted. So this is, of course, what we are after here. We want to see so what are the economic effects of these treaties? How do they actually affect kind of patterns of where people put their wealth? So what do we do? So we are lucky enough to have access to a, I'd say like a unique data set, probably like the only data set that could be used for this purpose on bank deposits and tax havens. I'll say more about that in a few seconds. And then we study how and by how much treaties change patterns of offshore deposits. Okay. So what do we find? So just a brief overview here. So contrary to kind of the most negative expectations, we actually find that treaties do matter. So treaties do change where people put their money. But so the bad news is that they change them in the way that they just make. So to some extent they make tax evaders move funds away from havens that sign treaties towards havens that have no treaties with their country of residence. Also, we see no signs of repatriation of wealth. And finally, we see no signs of increased self-reporting of wealth. So of course, there are some qualifications here, but it's, our basic message here is that it does not seem as if this policy initiative has really improved the tax collection as it stands. Okay, so the data part. When economists want to kind of make quantitative analysis of things relating to offshore things, the main challenge is, of course, is getting data, right? So how do you get data on these things when everything is so non-transparent and no one is really willing to give away information? We got access to this data set that is called the locational banking statistics of the Bank for International Settlements. So the BIS is kind of the central bank of the central banks. So this is like a very reliable source. These data are used for many things. So they're inputs to kind of current accounts, capital accounts stuff. So there's no reason to doubt the quality of these statistics. These banking statistics, they cover all financial centers. So basically, like when a financial center gets big enough, then the BIS includes it in their list of countries. So, and within each country that is reporting to these statistics, there's almost full coverage. So you cover all banks basically within these countries that are included by the statistics. So good for us here. So there are among these major financial centers covered by this data source, there are 19 havens, and for 14 of those we have. So then we see bilateral deposit data. So, for example, for Switzerland, Luxembourg, and Cayman, we have bilateral deposit data, meaning we see, for example, so what is the total value of deposits owned by Norwegians in Switzerland? What is the total value of deposits owned by Germans in Luxembourg? What is the total value of deposits owned by US citizens in the Cayman Islands? And then there are 5 more here for which we only observe kind of the aggregate, so that's like the total amount of foreign deposits. So this is a great data source, probably the only one you could use for this type of study, but it has some limitations. So one is that it includes deposits owned by corporations and funds. So we really want to study like the behavior of tax of households. So here we have like a measure of deposits that includes deposits owned by households, but also deposits owned by funds and corporations. It includes only bank deposits. Of course, there are other forms of offshore wealth. You can hold wealth like through a custodian bank in the form of securities. That is not covered. And then a final thing. So this is based on immediate ownership rather than ultimate ownership basis. So this means that if I am a Norwegian guy, I own a Swiss bank account in the name of a Panamanian shell corporation, then in the statistics it looks as if the deposit is owned by someone in Panama, and it's clearly not, right? It's so there's like, and this is actually like a pretty big chunk of these deposits that we basically cannot say who owns, because there's this shell entity probably in between the real owner and the assets. Okay. So how do we get about this analysis? So we conduct both a graphical analysis. So we look at just the raw numbers, put them up in nice scatter plots. I'll show you some of these graphs. Also, we conduct kind of standard panel regression analysis. I won't get into the details of that. I'm not sure there are so many economists here, so I'll just skip that and get to what we actually find. Okay. So what are the results? First result. A treaty between a country and a haven causes a 15% drop in the bank deposits held by the country in the haven. So when Norway signs a treaty with Switzerland, Norwegian deposits in Switzerland drops by 15%. How should we interpret that? Is that a big number or a small number? It depends, right? So first of all, we think that these responses come only from households. So we don't think of corporations and trusts as tax evaders. So it's probably like this only comes from households. But our measure of deposits includes both households and these trusts and corporations. So if I should interpret this, I would do it in the following way. I would say, okay, let's assume that corporations and trusts do not respond to these treaties. They shouldn't be affected. Let's assume that half of these deposits in havens are actually belong to households. This is like a number that people typically use. So that would mean that this 15% drop in total bank deposits corresponds to a 30% drop in deposits owned by households under these two assumptions. So this is still, this is a significant response, but under these kind of uncertain assumptions, but it's still a minority of households responding, right? So most of the people with deposits in these offshore jurisdictions seem to just leave their money where they are when a treaty is signed. So I promised you some graphical stuff also that is maybe easier to relate to. So what I do in this graph is that we have this bilateral data for 14 havens against 200 counterpart countries, so all countries in the world. So that gives us 2,800 country haven pairs, right? So what I do here is that I group these country haven pairs into two groups: those that signed a treaty between 2008 and 2011, and those that did not. So the ones that signed a treaty is the bold line, and those that did not sign a treaty is the dotted line. So you see that these two groups of deposits, like in each of these groups, follow each other pretty nicely up until 2008, and then there's kind of a small drop in the deposits owned by, or like in these haven country pairs that signed a treaty relative to those that did not sign a treaty. So it looks like a modest response, but again, like how to interpret this really depends on so what is the subgroup of people who actually responded to this. Okay. Result number 2. A treaty between a country and a haven causes a 0.6% increase in bank deposits held by the country in each of the other havens in the world. So if Norway signs a treaty with Switzerland, you see a 15% drop in Norwegian deposits in Switzerland, and you see a 0.6% increase in Norwegian-owned deposits in all of the other havens in the world. So in Luxembourg, Singapore, what have you, suddenly deposits go up. So you can twist this result a little. You can twist the model a little bit to get even closer to something that is kind of intuitive. So if Norway signs a treaty with Switzerland, so when would you expect to see shifting to Luxembourg? Well, only if Luxembourg does not have a treaty with Norway, right? There's no reason to expect people to try to escape a treaty by shifting the money to a haven that already has a treaty. So if you kind of allow this shifting effect to depend on whether the receiving country has a treaty or does not have a treaty with the country, then you get the following results. So a treaty between a country and a haven causes a 1.2% increase in the bank deposits in the havens that do not have a treaty with the country, and there is no change in the havens that do have a treaty. So if Luxembourg has a treaty with Norway and Norway has a treaty with Switzerland, then nothing happens in Luxembourg. If Luxembourg has no treaty with Norway and Norway has a treaty with Switzerland, then you see like a 1.2% increase in Norwegian deposits in Luxembourg. So this is kind of this is like pretty strong evidence, I think, of shifting that really kind of stocks go up where they're supposed to if people were moving their money around in order to avoid these treaties. So how does this show in the aggregate data? So here we have the 19 havens plotted in this diagram. So on the x-axis here you have the number of treaties signed by these havens. So there's Jersey that signed 19 havens in this period. There's Panama that signed only 5. And then on the y-axis you have the change in the in the total stock of deposits that they attract over this period. So you can see that the havens that signed little treaties attracted many more deposits, so they gained market share. So Panama got like an 80% increase in what they attract from foreigners. Whereas Jersey that signed these 18 treaties, they saw like a 60% reduction in the stock of deposits that they attract from foreigners. So this is also consistent with this shifting story, right? You just see kind of so the most compliant tax havens, they lose market shares in this global market for offshore deposits to these less compliant havens. Okay, result number 3. No repatriation of offshore deposits. This is a bit tricky to get at this question, so if people repatriate it, because we don't actually observe repatriation in our data set. So what I plotted here is so that the bold line here is the total stock of deposits in all offshore havens. So you can see that this this goes up like in the first part of the sample period up until 2008. And then it kind of flattens out, so there's the same kind of total amount of deposits in havens now as there was before this tax haven crackdown. There's around $3,000 billion in deposits. So of course you could argue that perhaps like if there had been no like treaty tax haven crackdown, then I mean you would have seen a higher growth. So what is the counterfactual here? What is it that what would have happened if there had been no treaties? So of course we can't produce like a really reliable counterfactual. We only note, you know, that this is the time of the financial crisis. So like all these international financial transfers goes down. If you compare to, for example, the dotted line here, which is the total deposits in all non-haven countries, so the total deposits in Germany, the US, France, for whom nothing changed because they already had these treaties, you see like a similar decline around 2008, 2009. So, so the total amount of deposits in these havens has been constant over this period. Another piece of evidence in favor of this conjecture here that there is no repatriation of deposits is this figure here. So here we look at each OECD country. So there are like 20-something OECD countries here. And we look at, as a function of how many treaties they signed with havens, how much did their total stock of haven deposits change. And you see that there's just no correlation here at all. So, so there's France that signed 15 treaties with the 19 havens in our sample. They saw like a small increase in their haven deposits. And there's Chile that signed no treaties, and they also saw a small increase in their haven deposits. So it's just not that those countries that signed many treaties achieved a reduction in the stock of deposits held offshore. Result number 4, no increase in compliance. So this is even more tricky to get at, because like in this data set we only observe deposits, so we see nothing about like whether people actually self-report their income or not. So you could claim that maybe people just left their money in Switzerland, Luxembourg, and whatever, but these treaties had this beneficial effect that they caused people to self-report their income because they're afraid of getting caught. And we can't see this in this main data set from the BIS. So, so we had to find kind of another data source that will allow us to get at this question. And what we use is a Swiss data set that has actually direct information on compliance, you can say, on voluntary disclosure of interest income. So to explain like why this is the case, I need to just say a few words of background here. So, so Switzerland has for a number of years cooperated with the European Union on something called the Savings Tax Directive. So under this directive, if I, as a Dane, a European resident, put money on a Swiss account, Switzerland will actually impose a withholding tax on my interest income and send the money to Denmark, most of it. So it's pretty costly now. There's a big tax cost of having like Swiss deposits if you are a EU resident. But under this directive, EU, so I can escape this withholding tax if I accept that the bank disclose my interest income to Denmark. Okay? So the default in Switzerland is anonymity, that I'm just taxed anonymously and the money is sent back to Denmark. But I can avoid this withholding tax if I let the bank tell my tax authorities at home how much interest income I had. So Switzerland actually publishes these figures. So for each of these EU countries, they publish what was the withholding tax revenue, so how much of this interest income was taxed, and how much interest income was was passed on to the how much information on interest income was passed on to the home countries. So for each of these 27 EU countries, we can compute the fraction of Swiss interest income which is voluntarily disclosed to the tax authorities. So this is like a direct measure of compliance, a direct measure of voluntary disclosure. So at least for one haven, and for this sample of 27 home countries, we can actually conduct a proper test of whether there was an increase in compliance as a function of these treaties. And the picture looks like this. So again, we group these 27 countries into two groups: those that signed a treaty with Switzerland during this period, and another group that did not sign a treaty with Switzerland. And this is kind of the average fraction of interest income that is disclosed voluntarily. So the first thing to note is that these figures are pretty low. So it's like 10-20% of households disclose. The rest are willing to pay this 35% withholding tax. Also note that there is kind of an increase in trend. So it seems that compliance is actually increasing in Switzerland among people with money there. But the last thing to note is that there's no difference between like those who signed a treaty and those who did not sign a treaty. So the treaty does not seem to have kind of an extra effect on compliance relative to just other countries. So of course this is, so there could be compliance effects in other havens. This is just like one important haven in Switzerland. There could be other things going on in other havens, but this is at least suggested evidence that there is no increase in compliance caused by these treaties. Okay. Result number 5. Evaders with sham corporations may have responded strongly. So this comes back to the presentation from yesterday about these shell corporations. So as I was saying before, kind of actually like around a quarter of all deposits in havens are assigned to other havens in these BIS statistics. So around a quarter of deposits in Switzerland are kind of officially owned by someone in Panama, someone in the BVI, someone in other havens. So we don't believe that these deposits are really owned by someone in Panama or the BVI. So this really must reflect these shell structures that we heard about yesterday. So in all the results you've seen until now, we basically thrown away this 1/4 of observations. We just say, okay, we don't know. I mean, we don't know who owns Swiss deposits that are assigned to Panama. We just know that they're probably not Panamanians who own all these billions of deposits held in Switzerland. So in what you've seen until now, we just threw these observations out. So here we look at, we try to look at how these deposits then respond, how did they then respond to treaties. So of course we cannot say, we still don't know who owned these deposits. So we see like a Panama owned deposits in Switzerland. We don't know who actually owns it. But still we can see how this type of deposits respond to treaties. So what we find here is that a treaty between a country and a haven causes a 1% drop in the bank deposits held in the haven through other havens. So when Norway signs a treaty with Switzerland, deposits from Panama drops. So when Denmark signs a treaty with Luxembourg, deposits from the BVI into Luxembourg drops. So of course, I mean, this is also a bit suggestive, but it's kind of it's a pattern that is that suggests that also people with sham corporations responded. So should they respond? Should we expect them to respond? Yes, we should. So if I am a Norwegian holding a sham corporation in Panama, owning deposits in Switzerland, I should be worried about a treaty between Switzerland and Norway, because treaties look through these structures. I mean, so the corporation is just a piece of paper in Panama, and Norwegian tax authorities can get like at this corporation. So we should expect something like this. On the other hand, a treaty between a haven and another haven, so if Switzerland and Panama sign a treaty with each other, nothing happens. And there shouldn't. I mean, because if I'm Norwegian and I hold my money in Switzerland through a Panama corporation, I don't care about a treaty between Switzerland and Panama. No one's going to come after me with this treaty. Yeah. So I'll wrap up. This was pretty close pretty fast, a bit faster than I thought. But it's the last presentation, so you can maybe just conclude the main findings. We find that actually, I mean, so these treaties they do have significant effects on the patterns of offshore deposits. But I mean, but most likely these responses were kind of small, and they most likely reflected deposit shifting, so shifting from havens with treaties to havens without treaties, and not repatriation of funds, and not compliance, not more self-reporting. So we think that these findings, to the extent that you believe them, that they point towards a policy agenda. First of all, I mean, the fact that you see a significant amount of deposit shifting really suggests that countries should endeavor to complete treaty networks. It's just not good enough to have 30 treaties. You need treaties with all 50 havens in the world. The second point here is perhaps a bit more questionable, but to the extent that we are right about these assumptions about the fraction of deposits owned by households, so that it's actually true that these responses were kind of small. It seems that the majority of tax evaders are not really afraid of the treaties. So this really speaks in favor of making treaties more demanding. So there's a small risk implied by these treaties of getting caught. There are many ways you could make these treaties more demanding. One way would be to have automatic reporting, of course, instead of information exchange upon request. So yeah, that's all I had.
As far as I understand, your advice is make all the treaties for all the countries. And could you tell me or the audience how far away are we from that goal? How many in percentage of possible treaties?
Yeah, I mean,
you had this.
Sure,
graph.
I mean, I didn't count it. I didn't count lately, but
is
I
it
mean,
like 20%
I would say no.
to
I'd say
the
that
goal, or 50?
So I think for the OECD countries, it's not so far away. It's probably like 40–50% like toward the goal.
Okay.
But for developing countries, I mean, we're almost maybe 1%, 2%. There are very few treaties between the developing countries and havens.
Mm. But you had some findings or some facts in the beginning of how much was deposited in percentage of household wealth, like 8%, I
yes.
think you said. Is that mainly rich people in the rich countries, in the OECD countries?
So we don't, yeah, I mean, so we don't really know. I mean, so yeah, of course, like it's a lot of people from the OECD countries, but also, of course, rich elites in third world countries.
Mm. But the conclusion should be that this is working, but it's not perfect. But if we try to push the agenda, it should have some effect.
I mean, I think the benign interpretation is that that this could be working. I mean, at least to some extent, if you would like sign more treaties, but you could, I mean, you could really still doubt whether you would ever get any compliance effects or any repatriation effects. Yeah. Hmm.
Just one final kind of technical question. You had one graph with Greece as an outlier.
Yes, that's a very interesting.
Could you just show that? What was?
I didn't. So this shows so how the total stock of offshore deposits changed from 2008 to 2011 for all OECD countries. And you see that that for Greece this increased by 200%. So this is like a clear example of capital flight, right? And that Greeks are just worried that their banks might collapse or that they'll have to start paying taxes, whatever. So they really sent their money abroad in big numbers.
Do you know how much money that is?
So that's actually something that I cannot disclose. So this is not public data. So I mean,
you know it and you can tell us.
Yeah, I'm sorry.
Okay, this is no press in the room.
So much for transparency, yeah.
Okay, but you know it and it's not public?
Yeah.
Okay.
Sorry about that.
That's good. That's not good. But the BIS, they publish a lot of locational bank data.
So what they do publish is that they do publish for each haven, they publish the total amount of foreign deposits.
Okay.
For each counterpart country, they publish the total amount of foreign deposits. So like the total amount of deposits held by Norwegians somewhere abroad. But what we got is this country-by-country data that is not publicly available.
What you say, we are not able to see how much Norwegians have deposited in Switzerland.
Exactly. Yeah.
Okay, that's a pity.
But yeah, that's a pity. So that, I mean, that of course should be changed. They should.
There's a follow-up question. I've got the mic, so I'm going to use my prerogative. But it's not on. Well, I still have it. Do you think this data should be public, and how do you think we can go about getting this data public? Because obviously that is, I mean, I saw that slide and it tells a story just in that picture. Yeah. And why is this data collected by a public body, not in the public domain?
I mean, so that's a very good question. And, yeah, I'm not from the BIS. I would be happy to have this data published any day, and and it's very important, right? So I mean, so if these data were public, then people could. I mean, then it would be like just be a click away from really following like this fight against tax evasion, right? And everybody could just sit down at the computer and track like how's it going, like, and now it's not possible.
Thank you very much. Sorry, I just want to ask this question. I don't know if it is more of rhetorics. Considering what tax havens cause and our broader understanding of them not just being tax havens, but secrecy jurisdiction that facilitate corruption and cause rot, as developing countries, should we be working towards treaties with them or working towards getting rid of them?
I'm not sure I get the question.
You're talking about treaties with tax havens.
Yes.
You said there are about 1% developing countries.
Yes.
But they are the OAC countries, they are getting around. Should we be working towards treaties with them? Would that help our cause? I mean, or should we be thinking of how to work together to see if we can completely eradicate them?
Yeah, I mean, that's a good question. I think that one important point is that these treaties are really so they are tools, but they're not really useful in themselves. So you need like a pretty sophisticated tax administration, I think, to have any use of them. I mean, you need resources to pursue these cases. You have to go out and actually ask questions. So if you have like a lack of resources in your tax administration already, and probably, I mean, they probably are not very useful. So.
I think Mr. Blum here.
Another question: isn't the FACTA law in the U.S. that's forcing a new kind of treaty much more important than the OECD nonsense that we're talking about here?
Yeah, so sure. So this, I mean, as I'm not an expert on the U.S. FATCA, but as I understand it, this is a more demanding kind of treaty that actually like has some kind of automatic reporting. So this is not a treaty where the U.S. has to go and ask about specific persons, but actually they will get information about all U.S. residents automatically every year.
Yes, but it's leading to parallel agreements where the U.S. will supply the other country on the other side with the same kind of automatic reporting. So, for example, within the last day, we've been reading about negotiations between the U.S. and Mexico on automatic exchange, which could have a profound impact.
So, yeah, okay. Is that a question or a comment? Or
it's a comment, but it suggests that the treaties that are evolving under that regime are going to be much more important than the stuff that OECD is.
I couldn't agree more, yeah.
I would like to say thank you once again. It's a pity that all the data are not available. Some good stories there.